Lyndon McClellan ran a convenience store in rural North Carolina for over a decade. Gas station, restaurant, small shop, everything legitimate. Every dollar earned from customers walking through his front door. One day, without warning, the IRS seized his entire bank account, over $107,000, gone. Not because he committed a crime, not because he owed back taxes, not because he laundered money, because his niece, who managed the deposits, had been putting cash in the bank in amounts just under $10,000. A bank teller told her it would be simpler that way, less paperwork. She thought she was being helpful. That one choice triggered a federal investigation, a civil forfeiture case, and months of legal battles to recover his own money back. But here's why I'm sharing this story today. In 2026, instead of when it occurred, the detection system that flagged Lyndon McClellan was basic compared to what banks are operating now. It identified a pattern. That was it. What replaced it is an AI-powered monitoring network that most Americans don't even know exists, and it is catching people every single day. If you think depositing $9,500 keeps you safe, this video is going to change how you think about your own bank account. We discussed the $10,000 rule on this channel before, but based on the comments I've received, based on the emails, based on the questions, most people still get it wrong. So let me be specific. Under the Bank Secrecy Act of 1970, every bank, credit union, and savings institution in the United States is required to file a currency transaction report, a CTR, anytime a customer makes a cash transaction exceeding $10,000, deposits, withdrawals, exchanges, any direction. $10,000 in cash, a report gets filed. That report goes to FinCEN, the Financial Crimes Enforcement Network, a bureau inside the U.S. Treasury, not the IRS, the Treasury, and the bank files it, not you. You don't sign anything. You probably won't even know it happened. Now here's where the confusion begins. The $10,000 threshold is not a limit. You can deposit $50,000 in cash tomorrow. You can deposit $100,000. There is no cap on how much cash you can legally deposit into your own bank account. The $10,000 number is a reporting trigger. That's all it is. Information goes to the government. Nobody shows up at your house. Nobody freezes your account. In 2022 alone, banks filed over 20.5 million currency transaction reports. 20 million. The vast majority led to absolutely nothing. A CTR is paperwork, routine automatic paperwork. But people hear federal report and they panic. They think if I stay under 10,000, nobody will notice. If I break it up, the system won't detect it. That instinct, the instinct to stay below the line, is the single most dangerous financial decision a person can make because staying below the line on purpose has a name. And in 2026, the system designed to detect it is no longer managed by humans looking at spreadsheets. It's managed by artificial intelligence, and it sees everything. For decades, bank compliance departments operated on rules, simple rules. If deposit exceeds 10,000, file CTR. If deposits below 10,000, appear in a pattern flag for review. A human compliance officer would examine the flag, decide if it was suspicious, and either dismiss it or file a report. That system had gaps. It was slow. It was inconsistent. And people learned to work around it. Deposit 9,000 on Monday, 8,000 on Thursday, different branch next week. The old system might catch it, might not. That system is gone. In 2026, the majority of major U.S. banks are running AI-powered transaction monitoring, not rule-based, not pattern matching. Machine learning systems that analyze every transaction you make in real time and compare it against behavioral models built from billions of data points. Here's what that means in plain language. The old system asked, did this transaction break a rule? The new system asks, does this customer's behavior appear normal? Those are fundamentally different questions. The old system could be tricked by spacing out deposits. The new system knows your deposit history, your income pattern, your typical transaction size, and your geographic behavior. If you normally deposit $2,000 every 2 weeks from your paycheck, and suddenly you start depositing $8,000 in cash 3 times in 10 days, the system doesn't need a rule to flag that. It flags it because the behavior shifted. But the technology that should concern you most is called entity resolution. Entity resolution is an AI capability that links your identity across multiple accounts, multiple branches, and in some cases, multiple banks. The old system saw each branch as an island. You could deposit $9,000 at the Main Street branch and $9,000 at the Elm Street branch, and the system might not connect them. Entity resolution connects them instantly. Same name, same social security number, same phone number, same address. The AI constructs a unified profile of you across every touch point, and it sees your total activity as one picture, not fragmented pieces. Multiple banks are now sharing anonymized transaction pattern data through consortiums specifically designed to identify structured deposits. Your bank doesn't need to see the deposit you made at another bank. The pattern analysis handles it for them. And there's a new layer for 2026 that didn't exist in previous years. Digital wallet and cryptocurrency deposits now trigger additional scrutiny. If you're converting crypto to cash through an exchange and depositing the proceeds, banks are now required to ask for proof of origin under updated anti-money laundering guidelines. Where did the crypto come from? When did you acquire it? Can you document the transaction chain? The system that flagged Lyndon McClellan looked at numbers on a spreadsheet. The system operating today watches behavior in real time, links identities across institutions, and learns what suspicious looks like from hundreds of millions of transactions. It doesn't sleep. It doesn't make judgment calls. It flags patterns at machine speed. The people who think splitting a deposit into $9,500 chunks is clever, the AI was specifically trained to detect exactly that behavior. It's the first thing it seeks for. Let's talk about what's actually illegal here, because the crime isn't depositing cash. The crime isn't triggering a report. The crime is trying to avoid the report, structuring under 31 U.S. Code, Section 5324. It is a federal offense to structure or assist in structuring any transaction with a financial institution for the purpose of evading the currency reporting requirements. Read that again. For the purpose of evading the reporting requirements. The law doesn't care where the money came from. It doesn't care if every dollar is legal. It doesn't care if you're a retired school teacher or a small business owner or a grandmother moving her savings. If you deliberately break up a transaction to stay under $10,000, you have committed a federal crime. The penalties are not theoretical for structuring involving less than $100,000 in a 12-month period, up to 5 years in federal prison, and up to $250,000 in fines for structuring involving more than $100,000 or connected to any other illegal activity, up to 10 years in prison, and up to $500,000 in fines. And in both cases, both the government can seize the money through civil forfeiture. They take the cash first, you fight to get it back later. And as Lyndon McClellan learned, later can mean months or years of battling. Now here's the part that concerns me the most. In 1994, Congress removed the requirement that prosecutors prove you knew structuring was illegal. Under current law, the government only has to prove two things. One, that you knew about the $10,000 reporting threshold. Two, that you intentionally structured transactions to avoid it. They do not have to prove you knew that avoiding the threshold was a crime. You can walk into a bank thinking you're being responsible, thinking you're protecting your privacy, thinking you're doing the smart thing, and you have just committed a felony. The intent to avoid the report is the crime, not the intent to break the law. And if you're watching this video, you now know about the threshold that eliminates half the government's burden right there. So, let me be direct. If you deposit money after watching this video and you break it into pieces to stay under $10,000, a prosecutor will say, and you knew, and they'll be right. Don't give them that argument. Most people think the CTR, the $10,000 report, is the only thing banks file. It's not even the most concerning one. The second report is called a Suspicious Activity Report, a SAR, and this is the one that should genuinely worry you at night. Here are 5 things that can trigger a SAR. Number 1, deposits that fall just below the $10,000 threshold. $9,000, $9,500, $8,700. The system is specifically looking for round number avoidance. If your deposits cluster below $10,000, you are virtually guaranteeing a SAR. Number 2, a sudden change in your transaction pattern. You've been depositing $2,000 a month for 3 years. Suddenly, you deposit $7,000, 3 times in a row. The AI doesn't see 3 deposits, it sees a deviation from your established behavior. That deviation triggers a flag. Number 3, multiple deposits at different branches or different banks in a short time frame with entity resolution, linking your identity across institutions. The AI sees this as a single pattern of behavior, not unrelated events. Driving to 3 branches in one day to make 3 deposits is not discretion, it's a roadmap. Number 4, refusing to answer the teller's questions or offering unusual explanations. If a teller asks where the cash came from and you say, I'd rather not say, or it's personal, or don't worry about it. That conversation goes into the SAR narrative verbatim. Compliance departments are trained to document exactly what you say. Number 5, third-party deposits. Having someone else deposit cash on your behalf. A friend, a family member, a business partner. This is called smurfing in anti-money laundering terminology, and it is one of the highest priority flags in the entire system. Now here's what makes SARs alarming. There is no minimum dollar amount. A CTR requires $10,000. A SAR has no threshold. A bank can file a SAR on a $500 transaction, a $200 transaction. There is no floor, and you will never know one has been filed against you. Federal Law 31 U.S.C. Section 5318G2 makes it a crime for a bank employee to tell you a SAR has been filed. The bank cannot inform you. The teller cannot alert you. Your banker cannot give you any heads up. You could be flagged right now and have absolutely no way of knowing. CTRs are routine. SARs are targeted. And in 2026, AI-powered monitoring systems file SARs at a rate and precision that would have been unimaginable 10 years ago. The old compliance officer reviewed maybe 50 flags a week. The AI reviews millions of transactions per hour. I don't want you to think this is hypothetical. These are real Americans, real cases, real consequences. Lyndon McClellan, convenience store owner in Fairmont, North Carolina. The IRS seized over $107,000 from his bank account in 2014. His niece had been making deposits under $10,000 after a bank teller suggested it would mean less paperwork. Every penny came from his legitimate business. An accountant traced every dollar back to his store's register. The government initially offered to return 50% half of his own money. A federal judge rejected that and dismissed the case with prejudice, meaning the government had to return all of it, plus interest and legal fees. But Lyndon spent over a year fighting to recover money that was never illegal in the first place. Carol Hinders, she owned Mrs. Lady's Mexican Food in Spirit Lake, Iowa, a cash-only restaurant she ran for 38 years. Because the restaurant only accepted cash, she made frequent small deposits. In August 2013, the federal government seized her entire bank account, nearly $33,000. She wasn't charged with any crime. She wasn't suspected of any crime. The deposits were small and frequent, and that was sufficient. It took the Institute for Justice and national media attention before the government voluntarily dropped its case and returned her money. 38 years of running a legitimate business, and she had to hire counsel and go to the press to get her own cash back. Randy and Karen Sowers, Maryland dairy farmers. They had $62,936 seized in 2011 because they made sub-$10,000 deposits. Their bank had recommended that smaller deposits meant less paperwork. The government forced them to settle, and they initially had to surrender $1,500 of their own legally earned money. It took congressional hearings and public outrage before the IRS agreed to return it. The IRS Inspector General reviewed 278 forfeiture cases where structuring was the primary basis for seizure. In 91% of those cases, 91% the money was completely legal. The owners had earned it, inherited it, or received it as gifts. They just deposited it in a pattern the system disliked. 9 out of 10 people who lost their money to structuring forfeitures weren't criminals. They were people like you who received bad advice, followed a common instinct, and paid for it with their savings. The IRS has since updated its policy. In 2014, they announced they would only pursue structuring forfeitures where the funds were connected to illegal activity. But SAR filings, AI monitoring, and the underlying structuring statute have not changed. The crime is still a crime. The AI is still watching. And if a local U.S. attorney decides your deposit pattern warrants attention, the 2014 policy is guidance, not law. Now let me give you the playbook. 6 rules that protect you. Follow these and you will never have a problem with the $10,000 rule. The AI detection system or a suspicious activity report. Rule 1, deposit the full amount. Always in one transaction, if you have $14,000 in cash from selling a car, deposit $14,000. If you have $23,000 from an inheritance, deposit $23,000. One deposit, one transaction. A CTR gets filed. Nothing happens. Your life continues. The report is not the problem. The report is your protection. When the government has a CTR showing you deposited the exact amount in one clean transaction, they have nothing to investigate. It's the split-up deposits that create suspicion. Rule 2, bring documentation. Every time you deposit a significant amount of cash, bring proof of where it came from. Selling a car, Bring the bill of sale with both names, the date, the amount, and signatures. Receiving a gift, have the giver write a one-paragraph gift letter. Their name, your name, the amount, the date, and a sentence that says, "This is a gift with no expectation of repayment." Inheritance. Bring the estate settlement letter, or executor documentation. This takes 5 minutes to prepare and it creates an unbreakable paper trail. Rule 3. Answer the teller's questions, briefly and honestly. The teller will ask where the money came from. This is normal. They're trained to ask. It's part of their compliance obligation. You say one sentence. "I sold my car. It's a gift from my daughter. I'm consolidating accounts." One sentence. Hand them the documentation. Done. What you do not say, and I cannot emphasize this enough, is anything that sounds like you're trying to avoid being reported. Do not say, "I want to keep this under the radar." Do not say, "Is this going to trigger anything?" Do not say, "Can I break this up?" Those exact words will appear in a SAR narrative. I've seen it happen. Rule 4. Never split a deposit across multiple days, branches, or banks. If you have one lump sum, it goes into one account in one transaction. Driving to 3 branches is not discretion. It is the textbook definition of structuring. The entity resolution systems will link every deposit to your identity, regardless of which branch or bank you use. Rule 5. Create a transaction records folder. Physical or digital. Every time you deposit more than a few $1,000s, put 4 things in that folder. A 1-sentence note describing the source. Received $14,000 from sale of 2019 Honda Accord to John Smith on the 5th of March, 2026. Supporting documents, bill of sale, gift letter, estate letter, award letter, your bank statement showing the deposit, and any transfer confirmation. If you move money between accounts, that folder is your complete defense. You will probably never need it, but if someone questions a deposit from 3 years ago, it takes 5 minutes to build and could save you years of stress. Rule 6. If you're a business owner who receives large cash payments, understand Form 8300. This is separate from the bank's CTR. If your business receives more than $10,000 in cash from a single buyer in one transaction or in related transactions, you are required to file IRS Form 8300 within 15 days. You must also notify the buyer in writing by January 31 of the following year. This applies to car dealers, jewelers, attorneys, real estate brokers, contractors, and any business that regularly handles significant cash. Failure to file carries penalties starting at $100 per occurrence, and willful failure to file is a criminal offense. If you run a cash-heavy business, Form 8300 compliance is not optional, and the AI monitoring systems are now cross-referencing business deposit patterns against Form 8300 filing history. If the bank sees large cash deposits from your business account, but FinCEN doesn't have matching 8300 filings, that gap itself triggers a flag. If you receive a letter from a federal agency, FinCEN, the IRS, the Department of Justice, or if anyone from the government contacts you about your banking activity, you do one thing. Stop talking. Do not answer questions. Do not sign anything. Do not try to explain yourself. Do not call the number on the letter and try to sort it out. Every word you say can and will be used in a forfeiture proceeding or a criminal case. You say 5 words. "I'd like to contact my attorney." Then you find a tax attorney or a criminal defense attorney with experience in Bank Secrecy Act matters. Not your regular accountant, not your financial advisor, an attorney. Because attorney-client privilege protects your conversation. Nothing else does. If the government has already seized funds, you have the right to contest the forfeiture. Since 2019, the Taxpayer First Act requires the IRS to demonstrate probable cause that structuring funds were connected to illegal activity before pursuing seizure cases. That's a stronger protection than existed when Lyndon McClellan and Carol Hinders lost their money, but it only helps you if you have an attorney who knows how to invoke it. The worst thing you can do is try to handle it yourself. The second worst thing you can do is wait. Let me leave you with the one sentence that captures everything in this video. The report is not the crime. The crime is trying to avoid the report. The $10,000 rule is not a trap. It is not designed to catch retirees or small business owners or grandparents moving their savings. It's a tool for detecting financial crime. But the AI systems enforcing it in 2026 do not know the difference between a drug dealer structuring cash and a retired nurse who received bad advice from a neighbor. Deposit your money, all of it, at once. Keep your records clean. Answer honestly. And never under any circumstances break up a deposit to stay below a threshold. The people who follow those rules have nothing to worry about. The people who think they're being clever are the ones who lose everything. If someone you know handles large amounts of cash, a parent, a spouse, a friend, a business owner, send them this video. 20 minutes now can save them years of problems later. Drop a comment. Have you ever had a bank question a deposit? Have you ever been tempted to split one up? Tell me what happened. I read every single one, and the most common situations become future videos.